A very good afternoon, everyone, and thank you for joining us today. We may all know that investing is all about avoiding the noises in the market and investing for the long term. But at the same time, it's equally important to understand which events will eventually impact the market. I'm sure all of us have been hearing a lot about the concern and have the concerns regarding the expensive valuations, the recent geopolitical tensions, and the ambiguity regarding the rate cut timings. So to address it, we have Mr. Ashish Gupta, CIO at Axis Mutual Fund with us. He's going to share his view on market, address your concerns, and guide us on how to invest. Ashish has a rich experience of 25 years. He was one of the earliest to identify the asset quality cycle in Indian banks in 2011 and authored several market reports, including the House of Debt series. So, welcome, Ashish.
Thanks, Shikha.
So, Ashish, I'll be talking on behalf of all the investors when I ask you the first questions. That all of us are worried about the recent geopolitical tensions. So, could you throw some light on it, how it's going to influence the crude oil prices and the broader market indices?
Sure. So I think one thing we all know is what markets don't like and what equity markets don't like in particular is uncertainty. What recent events over the last 2 years have seen is that from an era where geopolitical tensions were only reflected in terms of Cold War, we have come to an era where there are actual armed conflicts on in the world right now, right? And we have now seen the conflict in the Middle East widening and taking on more and more countries in its arms. So I think that is certainly a cause of worry. This is a space that we need to watch very, very closely. Having said that, while on oil prices, there is likely to be an impact in the shorter term, I think oil prices is something I don't worry about in the medium to long term because one structural trend that has been very visible over the past few years is a shift in renewable sources for fueling growth. Right? And I think that trend is only accelerating. Every increase in oil prices, every such event only accelerates this trend. We have seen how after the Ukraine-Russia conflict, concerns about gas coming into Europe has led to many European countries, including Germany, moving away from relying on gas. We have also seen the US, which was at one point of time the largest consumer and importer of crude, now not importing crude at all. So I think those are the real structural challenges to oil demand in the medium to long term. So while there will be near-term volatility in oil prices for sure, given the recent events and given the fact that Iran, which is now in the center of this, accounts for a significant portion of global oil production. The fact is that on a structural basis, I do not think oil prices is something that can sustain at a very elevated level for a long period of time. If we look at ourselves, the India market and the Indian macro, I think that is also now much more stronger to absorb any of these potential shocks. Uh, the direct impact for us, given that we still use oil for the large part of our fuel consumption, uh, uh, has always been that it leads to a spike in current account deficit. There was a time when oil prices were not regulated, so it meant increase in fiscal deficit as well. The latter is no longer true. So there's no major impact likely on the fisc. There can be an impact on the current account. But if we look at the March quarter, we are actually going to likely have a current account surplus of about 1% of GDP. Therefore, even if, say, oil prices for the quarter are higher by $10 to a barrel, hypothetically, that still will not put us back into a current account deficit. So I think the fact that fundamentals of India are so strong, the macro is strong, we have almost $650 billion of forex reserves. I think we are quite resilient to withstand these shocks in the short term. And oil prices is not something I worry about for the medium to long term. But the fact that there is increased geopolitical tensions, there is likely to be disruption in supply chains, realignments about lobby groups within countries, that is something that we need to be more watchful about.
Thank you, Ashish. So as you said that the fundamentals and the macros are strong for India, but there have been a lot of concerns on valuation part. We have been called an expensive economy compared to the global markets. So what do you think that will impact, especially on the FPI flows, which are turning positive? And do you advise people to be invested at this valuations?
So, no doubt, India's valuations are at a premium, not just in relation to the international comparable, but even if you look at our own history, today, Nifty is trading at a little over 20 times forward earnings. Historically, it has traded on average at about 16 times. The broader market multiples are also higher than where they have been historically. But two things that support it. One is the fact, and again, I'm repeating myself, that the macro fundamentals are much, much stronger. I mentioned about the balance sheet of the country, which is much better, both on the current account side, on the forex reserves. The balance sheet of the government is also better. Our fiscal deficit has been coming down. Our tax to GDP ratio has improved. If we look at corporate balance sheet, that is also much better. So debt to equity levels at corporate India are at a 15-year low. Bank balance sheets are also much stronger. So I think all this translates to the fact that we can be more confident about the growth outlook of the economy. For next year, growth is forecasted to be in excess of 6.5%. And if that comes through, it will mean that we'll have close to 7% growth in India for third straight year running. India will be the fastest growing economy globally, large economy globally. And if that happens, then I think these valuations are sustainable, right? So the key really, to my mind, is not that valuations are too expensive. The key for me to watch out for is how sustainable is the growth, both in terms of the overall GDP growth as well as the corporate earnings growth.
So, Ashish, when you say that the valuations about the valuation, so do you think the same way for the large, mid cap, and small cap, or will you advise investors at the time to move to a safer side like large cap?
So I think today there is increased gap between the valuation of mid and small cap compared to the large cap. It's really born out of the fact that last year, while the Nifty was up about 28 to 30%, mid and large cap indices were up nearly 60%. If we see the difference in multiple of mid and small cap versus large cap, it is wider than what it has been historically. And it's only about 10% of the time in history had the valuation gap between mid and small cap being this high compared to large caps. Having said that, it is also true that the mid and small cap offer better growth opportunities. If we look at the large cap universe, it is dominated by several companies like the IT services companies, some of the banks, some conglomerates, where the earnings growth is not as strong, right? So if we look at Nifty earnings growth forecast for next year, it is only about 10%. If we look at the mid cap and the small cap, so several of the high growth sectors, whether we talk about capital goods, industrial, investments, manufacturing, real estate, tourism. These companies are actually more represented in the mid and small cap segment, and therefore the earnings growth in this segment is better. Therefore, my advice to investors will be to have allocation both to the large cap as well as mid and small caps. Investors should always have a diversified portfolio. So my recommendation would not be that you should solely be in large caps.
Okay. Ashish, one more question on valuation because market में इसके regarding काफी questions there. And the another hot topic from this perspective is the PSUs. Last year PSUs ने काफी अच्छा growth दिया. People have made a lot of money. So do you believe that the story is continuing despite that कि PSU valuations जो है it's very close to its long-term average now?
Yes. So I think you have partly answered the question. I think one of the reasons we have seen this sharp uptake in PSUs is that the starting point was very low. So the valuation discount of PSUs relative to the broader market was very high. If we see last few years, the strong resilience of traditional sectors during COVID has meant that many of these PSU companies have done well. Government policies towards defense indigenization has benefited these companies. We have seen balance sheet cleanup also coming through in many of the PSUs, including banks. And the other fact that has been observed in the last 3-4 years is that corporate governance in PSUs has been strengthened. So most of them now have formalized payout policy, dividend payout policies. So I think there has been a good reason for the multiples for these PSUs to recover and come back to their long-term averages. I still think there are pockets of PSUs that are still attractive. काफी PSUs are now in growth mode, especially in sectors like power, defense, जहाँ पर इनकी competitive positioning is very strong and outlook for growth in these sectors is also positive. So I will still say that people should stay invested in selective PSUs. Not all PSUs have the same growth outlook. So I don't think the PSU rally will be as broad-based this year as it was last year, but some PSUs will certainly do well.
Thank you, Ashish. One more thing जो आजकल मार्केट में काफी डिस्कस होता है is global markets. So अगर हम start of the year में देखें, so there were aggressive rate cuts expectations by global markets, especially Fed. But what do you think how the current scenarios are shape up and ये rate cut cycle कैसे pan out होगा?
So अगर हम start of the year की बात करें तो I think market was a bit too aggressive in pricing in 5 to 6 Fed rate cuts. I think in the last 3 months, as US GDP data has come through, we have seen continuous upside in the US growth estimate. Of course, this is on back of the huge fiscal support that has been provided by the US government. But the fact is, given that US growth has been coming so strong, the expectation of Fed rate cuts has been pushed back. I think the expectations are now much more realistic that there will be 1 or 2 rate cuts in the US. I think one thing is been proven decisively that we have seen the peak of rates cycle because if you look 2 years ago in 2021-22, the inflation rates in these economies, and I'm talking about the G5, so not just the US but including Europe as well, was close to double digit. that has now come down to 3 to 4%. So I think peak of the global rate cycle is certainly behind us, but the pace at which rates come down is still to be seen, and we don't think the pace will be as aggressive as what was being forecasted at the start of the year. But 1 to 2 rate cuts in the US this year is certainly likely.
I just like to mention that US rate cut expectation has been pushed, and at the same time, RBI has also indicated that they will not be influenced by US rate cut. So, do we believe that it will impact the India rate cut cycle, given we still have strong macros?
So I think while India indeed has strong macros, I think somewhat like the US, the Indian central bank will also probably be in no hurry to cut rates. And this is coming on back of the fact that even in India, for last 6 quarters, you have seen that GDP growth coming out ahead of RBI's own expectation, right? So I think in this scenario, there is no reason that RBI should become more aggressive in cutting rates. Uh, of course, the fact is that inflation in India has also trended down. You would have seen this month the core inflation number has actually dropped below 4%. So RBI has really flexibility to cut rates, but given that the growth is coming in so strong, the fact that credit growth in India is running at almost 16%, well ahead of nominal GDP growth. So it is not even the case that today interest rates are at a level that it is impacting credit demand. तो मुझे नहीं लगता कि RBI will be in a hurry to cut rates. I think with the moderation in inflation, RBI will continue to support growth by providing liquidity in the market, but may not be aggressive in cutting rates.
आशीष, अगर हम बॉन्ड मार्केट की बात करें यहाँ पे, तो वी हैव सीन स्ट्रॉन्ग एफपीआई flows in debt, especially because we expected to, they're expected to increase because of the GSEC being included in the global indices. So आपको क्या
Yes.
लगता है इसका इम्पैक्ट जो है मार्केट के डिमांड सप्लाई डायनेमिक्स में कैसा रहेगा और इस पे यील्ड पे क्या इम्पैक्ट
So,
आएगा?
so I think demand supply dynamics of bond market, particularly government bond market, is very favorable. With the inclusion in the bond index, estimates are that there will be 20 to 25 billion dollars of inflows into the Indian bond market. What we have seen in the current year so far is about $8 billion or about $7.5 billion of inflow. So there is potential for another 15 to 20 billion dollars of flows coming in. Having said that, we also need to watch out what is happening on global bond yields. You would have seen US 10-year bond yields have now gone past 4.5%. So if the global bond yields stay elevated, we might not see the entire 15, $20 billion of inflows coming through very quickly. I think in terms of domestic bond yields, the other factor is also where does the RBI feel comfortable with the yields to be, and what is the liquidity environment? Because while foreigners will be buyers of bond, we also need to see how much of bonds are bought by RBI, how much of bonds are bought by the banking system. So the domestic liquidity environment is frankly something that the RBI determines. But I think today, with 10-year yield at 7.2%, I think it's an attractive level, given what we have seen on the inflationary front in India, as I mentioned, with core inflation below 4%, and if headline inflation also tracks that, real rates in India are relatively high. So we can see the yields in India softening as headline inflation comes down along with the core inflation.
So thank you, Ashish. We're getting lots of question on gold. I think I'll just sum up and ask one of that gold, especially among the precious metals, have given a phenomenal return in the last couple of months, and oil is
Yes,
also another hot story. So what do you think is the ideal
yes.
allocation for investors, and should they consider commodities as a part of their allocation?
Certainly, I think all investors should have a multi-asset basket to invest in at all points of time. So their portfolio should have allocation to equity, debt, commodities. I think what we have witnessed in gold prices over the past few months has also been a reflection of the safe haven demand for gold, given the rising geopolitical tensions over the last 2 years. It has also been because there has been increased demand from multiple central banks, including that of China, to increase allocation of gold in the reserves and reduce some of the allocation to US debt that they have had. And this has clearly followed what happened in Russia and the fact that US fiscal deficit continues to rise. So I think there is certainly a case for the allocation to precious metals in the portfolio, and investors should have a well-diversified portfolio.
Ashish, when we're talking about diversified portfolio, what do you think an active fund and a passive fund plays a role there?
So I think both provide a positive contribution to an investor's portfolio. I think both can be used to optimize the risk reward in an investor portfolio. Uh, I think my advice to people will be to play cyclical themes. They should look at exposure through passives, to play a long-term themes, to invest in quality portfolios. They should use active funds. But I think a combination of both is really ideal.
Ashish, another question that you have got from our investors is what are your views on your recently launched fund, Access India Manufacturing Fund?
Sure. So typically, as a house, we have really not had many thematic products, right? So most of our active strategies are very diversified. And last year, we actually launched the manufacturing fund because we believe that it's really a theme that is not just cyclical but structural. It is also a very broad theme. So if you see our manufacturing fund, it covers 11 sectors, 66 industries. And what we are seeing in India, where there is a revival in the manufacturing cycle, if you see the print of GDP in the last 2 quarters, most of the upside surprise to the GDP came because the manufacturing part of the economy surprised on the upside. The government initiatives on manufacturing also make it a strong structural theme. So you have Make in India, where the focus is coming on India for the Center for Manufacturing, Design and Innovation. There has been PLI schemes launched across multiple sectors, including electronics and now in semiconductors. अगर आप आत्मनिर्भर भारत की बात करें तो there is encouragement for support to import substitution. So I think given the fact that now we are looking for political stability post this really looking for the China plus one strategy being followed by many economies. So I think in light of this, we are quite confident that manufacturing is a multi-year theme and should find a dedicated allocation in investors' portfolio.
Okay, I'm sorry. I think connection issue. Like of all the questions we have been getting, I think investors are really confused where to invest in at this point in time. The market has been very volatile. There have been segments which have given return, which earlier I think for 5 years have not given return. So, what do you advise them in terms of their portfolio construction and long-term wealth creation?
So I think the ideal thing for the investor at this point of time to would be to invest in a diversified portfolio. So really a flexi cap scheme or the multi cap scheme will be good. The more conservative investors can actually think of using hybrids. And it could be a really a dynamically managed hybrid fund like the Balance Advantage Fund. So some of the diversified strategies I think are the best to invest when there is uncertainty. So these three would be my top recommendation.
Thank you so much, Ashish. You have addressed a lot of concerns, especially on the hot topics, which is, I think, in every investor's mind at this time. So I hope everyone got some views out of it. And as Ashish said, invest for long term, keep it diversified. Choose between. It's not about choosing between large and small. You should be investing across the asset classes and across the market cap. So thank you so much, Ashish, once again, and thank you everyone for joining the call.
Thanks, Shikhar.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.